So today we're going to talk about Chapter 2, Recording Business Transactions. We're going to explain accounts and how they relate to the accounting equation and describe common accounts. So, real quick, does anyone remember what the accounting equation is?
Assets equals liabilities plus equity.
Yes. Assets equal liability plus equity. Perfect. This is the accounting equation. This is very important, so make sure that you know this. This is the basic version. There is an extended version of the accounting equation that just shows a little more detail of the accounts that are involved, and that's back in Chapter 1. We're going to define debits, credits, and normal account balances using double entry accounting and T accounts. We're going to record transactions in a journal and post journal entries to the ledger. Prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. Use the debt ratio to evaluate business performance. So first, explaining accounts, how they relate to the accounting equation, and describing common accounts. So we just mentioned what our accounting equation is, and that is assets equal liabilities plus equity. These are the three different parts of the accounting equation, and each part contains various accounts. So, for example, there are several different asset accounts. There are several different liability accounts. There are several different equity accounts. An account is the detailed record of all the increases and decreases that have occurred in an account during a specific period. So here on Exhibit 2-1, this is on page 57 in your book, we have a list of some asset accounts, and then we're also explaining those types of accounts. So for example, asset accounts are cash, accounts receivable, notes receivable, prepaid expense, equipment, furniture, fixtures, building, land, and it can go on and on and on. So you can have more asset accounts than that, but these are just some of the more common asset accounts that we see. So we're not going to test you on every possible asset account. But these are the most common ones. So cash is a business's money. It includes bank balances, bills, coins, and checks. Accounts receivable is a customer's promise to pay in the future for goods or services sold. It's often described as on account, which we mentioned last week. So if someone buys something on account, it's kind of like credit, like a store credit or something. I think the example was like Home Depot or something, and a contractor, where a contractor may go to Home Depot and ask to get some building materials, and maybe they sent their employee to get the building materials, and the employee doesn't have the cash to buy the building materials. The contractor can ask that Home Depot give them the building materials now on account, and then they pay for them later. And that would go into Home Depot's accounts receivable, meaning that Home Depot expects to receive the money for those materials, but they did not get the cash when that transaction took place. Now, Home Depot is not going to do that for everyone, and they don't do that for everyone. But just to use that as an example, a lot of times contractors who do a lot of business with them, they will have some type of system set up. So notes receivable. So notes receivable is a written promise. So it's where they have created a note, they have written a promise that a customer will pay a fixed amount of money and interest by a certain date in the future. And usually it's more formal than an account receivable. Why do you think that is? Because it's written. Yep. So, and can you think of an example of a note receivable? Yeah. It could even be where maybe a friend, relating it to personal life. Maybe a friend says, hey, can I please borrow $500 from you and I'll pay you back later? Well, you can either just give them the cash, or you could have them, sign a piece of paper stating that you loaned them $500, they're going to pay you back later. And that would actually be a note receivable for you, because you gave this money to this friend. They signed a note or a piece of paper stating that they will pay you back. So now you have a note receivable showing that they owe you $500. And hopefully they pay you back. And then if you wanted to add interest, you can. But what about prepaid expense? So prepaid expense is a payment of an expense in advance. So it's where we pay for something that we know we're going to have to pay for, but instead of waiting until the due date, we pay it early. So a good example of this would be like rent. So rent is due on the 1st, but we paid it on the 30th of the prior month. This is considered to be an asset because the prepayment provides a benefit in the future. So since we paid it on the 30th, we don't have to pay it on the 1st. So it's considered an asset while it is prepaid. Some examples are prepaid rent, prepaid insurance, and office supplies. So the same thing, prepaid insurance, you could pay that early as well, and then your office supplies when you purchase those. And then once the 1st hits, then it's expensed. So it's no longer considered prepaid, right? Because it's actually due on the 1st. So now it's expensed. Equipment, furniture, and fixtures. These are also all assets. The cost to purchase the equipment, the furniture, and the fixtures, such as light fixtures and shelving. A business has a separate asset account for each type. So you might have an equipment account, a furniture account, a fixture account. And depending on the size of your business and how detailed you want your reports to be, and if you're tracking depreciation, and we're not going to go too much further than that because I don't want to, but you may have multiple accounts for each of these. So for example, equipment, if you are a company that uses a lot of equipment, maybe like manufacturing or something, you may have a main equipment account, and then you may have what's called sub accounts underneath those, and you may have equipment, tractor, equipment, tractor, what goes with tractor? Now I'm thinking farming. What's another farming tool besides a tractor? Okay, equipment tractor 1, equipment tractor 2. So you may break these pieces of equipment out into sub-accounts so that you can track each piece of equipment. And they may cost different amounts of money, right? So maybe you bought a lower model at first, and so that was $10,000, and then you decided that you needed a better model than that. So now you have your equipment tractor 2 cost that was $10,000, so $15,000. So you may want to track all of that separately. So it just depends on, a lot of the accounts and the way that they're structured depends on the business, but this is the general structure of the accounts. I just want you to know that in case you ever do get into accounting, that these are our basic accounts, but there are other accounts that you can see. Or if you ever look at companies' financials and stuff like that, then you may see, I mean, income statements can be pages. So depending on the company. Building. So a building is also an asset, and this is the cost of the office building, store, or warehouse. And land. This is the cost of land that a business uses in operations. So all of these are asset accounts. And then we have liabilities. So liabilities, some examples are accounts payable, accounts payable, notes payable, accrued liability, and unearned revenue. Accounts payable is a promise that's made by the business to pay a debt in the future. It arises from a credit purchase. So this accounts payable is where we purchase something, but we are not paying for it until a later date. Notes payable is a written promise made by the business to pay a debt, usually involving interest in the future. Accrued liability is an amount owed but not paid. So we owe it, but we have not paid it yet. It's a specific type of payable. For example, you have taxes payable, rent payable, salaries payable. And then unearned revenue is when a company receives cash from a customer, but we have not yet provided the good or service. The promise to provide services or deliver goods in the future. So they went ahead and paid us, but we have not yet earned what they paid us for. And then equity accounts. These accounts are where you find your common stock, dividends, revenues, and expenses. And so common stock, this represents the net contributions of the stockholders in the business, and it increases our equity. Dividends are distributions of cash or other assets to the stockholders. This decreases our equity. So dividends is when we're paying the money out. So it's going to decrease our equity. It's a distribution to our stockholders. Revenue, this is earnings that result from delivering the goods or services to our customers. And revenue will increase equity. So I'm going to pause for a second. All right, so common stock increases our equity, right? So this is where I said this is our basic accounting equation. But then under equity, we have these other accounts that we saw last week that were broken down in our accounting equation. So common stock is part of equity. And common stock increases our equity. Dividends decreases our equity. Revenue increases, and expenses decreases. Just to kind of put that up there so that you have that. So for expenses, these are the cost of selling goods or services. They decrease equity. Examples of expenses include rent expense, salaries expense, and utilities expense. And let's see, oh, here. All right, so now we're going to talk. Does anybody have any questions about that so far before we get into the chart of accounts? No? Okay. All right. So now we're looking at the chart of accounts. This is on page 59. And this is a good example for you to use while working on your assessments. Really all of what we've talked about so far. But a chart of accounts is used to organize a company's accounts. A ledger is a record that holds all of the accounts of a business, the changes in those accounts, and their balances. So a ledger is where we go to see all of the account activity. So this is an example of the chart of accounts. So we see here we have assets, and then this lists out all of our asset accounts. And this is showing us, let me get a little color thingy there. So these are all of our balance sheet accounts. And these are our income statement accounts. So balance sheet accounts, these accounts are where our assets, our liabilities, and our equity accounts will flow. These will flow to our balance sheet. Our revenues and expense accounts, these will flow to our income statement. Now, looking at our asset accounts. So our asset accounts, we have cash, accounts receivable, notes receivable, office supplies. We have all of these different asset accounts listed here. Next to them, there is a number. So we use a numbering system for our chart of accounts. In this example, they used 3 numbers. Depending on the size of the company, some companies use 9 numbers, or, so it just depends on the size of the company and how many accounts they expect to have. So thinking about that, 9 numbers, that's a lot of accounts. If you're using 9 digits for your accounts, right? So think about like really large companies. I guess we'll go back to Home Depot. You've got Home Depot, and then Home Depot has tons of Home Depot stores and chains and all kinds of stuff, right? So they probably use a lot of digits for their accounts. But there's something else about these numbers. So if you look here, do we see any types of patterns? So we've got all of our asset accounts, all of our liabilities.
100, 200, 300.
Yes. So for some reason, all of our assets start with 1, and all of our liabilities are starting with 2, and our equities are starting with 3. Revenues 4, expenses 5. So when we're setting up our chart of accounts, we want all of a particular type of account to start with the same number. It just makes it easier to identify if we're ever looking for a particular account. So in this example, our assets all start with 1. Our liabilities all start with 2. And then there is something else about these numbers and accounts as well. I know I mentioned it last week, and we mentioned a lot last week. So with assets, the first account listed is cash, and then the second account listed is accounts receivable. And we have 101, 111, 121. So these numbers are going up the further you go down, right? So if we said this was 1, then this, I'm gonna put this in smaller numbers, then this would be 11. The first account listed always is going to be the most liquid account. Liquid meaning the quickest account that you can convert to cash. So if you get in a financial spot and you need money quick, what is the quickest account that you can convert to cash? Cash is already cash. Yeah. So cash is always the first account listed. So when you're creating your balance sheets and you're entering in your assets, cash is always going to be the very first account that you put up there. And it is important that you list your accounts in order of liquidity. Some accounts, I know, like some accounts are kind of tricky, and well, which one might be more liquid than the other? But cash is very Cash is cash. So it's always going to be the first one. So cash is listed first on your assets. And then normally accounts receivable will follow that, because most of the time you expect to get paid within a certain time frame, and normally at least within 30 days. You may get paid within 7 days, a week. You may get paid you may get paid the next day. So accounts receivable is normally always second. Notes receivable, we talked about, this is like a signed promise to pay. So this is something that you probably don't expect to get within 30 days. Maybe you do, but normally a note, you're probably looking at a couple of months, and that's why you took the time to write it out and have it signed. So that would be listed after accounts receivable. And then office supplies is listed after that, because if you need cash quickly and you're looking to your office supplies account, what do you have to do to turn it into cash? Do what? Sell it. You have to sell it. So you have to find somebody that wants to buy it and then sell the supplies to get the cash. Same thing with furniture, right? And building and land. Now, the reason that they're listed in that particular order is it's probably easier to sell office supplies, or quicker to sell office supplies, than furniture, maybe, and then maybe you can sell the furniture, but that's probably quicker to sell than the building, and the building's probably quicker to sell than the land. So it's all in order of liquidity, how quickly you can convert it into cash. Land is normally the longest to convert to cash, because it's expensive and people have to want it, and location and all of that. So that's why the accounts are listed that way. And the same thing goes for your liabilities. Liabilities are also listed in order of liquidity. So when we look at accounts payable, this is where accounts payable are normally things that we are going to be paying fairly quickly, probably within a couple of days or even maybe a week. Salaries payable, I would say the longest would be a month. Probably most jobs pay either weekly or bi-weekly. Then you have some that pay monthly. And then interest payable, and then you've got your unearned revenue. So this is anything that we have not yet earned. And then we have our notes payable as well. But so that's our liabilities. And then our equity, for equity, we have our owner's capital account and our owner's withdrawal account. Capital is just, what the owner puts in to the account, the owner's portion of the business. Owner withdrawals, what the owner takes out, the owner's, what when they take cash out of the business, that'll be shown in the owner withdrawal account. And then for the income statement accounts, we have revenues and expenses. And under our revenues, we have service revenue and interest revenue. And then under expenses, we have rent expense, salaries expense, utilities expense, and advertising expense. And these are also listed, you notice here, we've got our chart of accounts numbers 400, 411, and then 501, 511, 401, sorry. So that's basically, this is what a standard chart of accounts would be set up as. And then again, like I mentioned before, you can see other accounts listed here. You could maybe even see breakdowns. So you may have a company that tracks, maybe they have multiple locations. So under building, they've got building A, building B. So you may have those broken out even further, but this is what the standard chart of accounts would look like. And we see here balance sheet accounts, and then we have our income statement accounts. Do you have any questions about that? No? Okay. All right. So we're going to move into learning objective 2.2. And for this one, we're going to define debits, credits, normal account balances, all using double entry accounting and T accounts. Knowing the normal balance, I'm going to go back one. Knowing the normal balance of the account can help you to ensure that when you make your T accounts for your assessment, you are putting things on the correct sides. You're debiting the debits, you're crediting the credits. So just keep in mind the normal balance of the account. The normal balance, we'll talk more about this, but the normal balance is the side that it normally always falls on. So we said, let me get my little marker, get a different color. So we said cash is an asset. And just to kind of let you know, just to tell you like a little trick, maybe, I don't know if this will help or not, but if you think about the equal sign as being 0, when you are increasing an asset, you're moving away from the 0, you're increasing the asset on the left side. So an asset increases to the left, and the left side of a T account is what side? Is that a debit or a credit?
Debit.
It's a debit. So that's the debit side, and that's the credit side of a T account. So if we're increasing a liability, how do we increase the liability? If an asset increases by moving left, then the liabilities and the equity accounts, equity normally, these increase by moving away from the 0 as well to the right. So if we move to the right, this will increase, and the right is the credit, right? The right side of your T account is the credit side. So cash increases with a debit. Liabilities increase with a credit. Just like a little note. We already know that these are a little tricky because we have the arrows here that I drew earlier. So these are a little tricky. But assets increase when you move to the left-hand side is the debit side. So that means if the asset account increases with a debit, the normal balance of an asset account is a debit. So the normal balance for cash is a debit. And we do have a breakdown on that. So you need to know this for your assessment. And you'll have questions on it for your homework and quizzes and stuff too. But some of you have already been working on your assessments, and so you know that there are lots of T accounts on the assessment, and you need to know the normal balances so that you make sure you create your T accounts correctly so that you then pull in the information for your other requirements correctly, because if one part is incorrect, the whole thing will probably be incorrect. So just a side note, so pay very close attention to what we're fixing to talk about. All right, so what is double entry accounting? Double entry accounting is when one transaction will always involve at least 2 accounts. So if we pay cash out, well, what are we paying the cash out to? We're not just giving it to the air, right? Hopefully. I mean, we're not just tossing it in the air. And even if we were tossing it in there, then we'd probably end up considering that a donation, right? We're donating our money to whoever picks it up. So transactions always involve at least 2 accounts. Accounting uses the double entry system to record the dual effects of every transaction. For example, office supplies are purchased for cash, requiring an increase in office supplies, which is an asset, and a decrease in cash. So the 2 accounts that were involved are office supplies and cash. And then the T account. So the T account is a shortened form of the ledger. The left side of the T account is the debit side. The right side of the T account is the credit side. And there are increases in and decreases in accounts. So how we record the increases and decreases to an account is determined by the type of the account, which we've kind of talked about. But so this is a really good slide to come back to. This is slide 14. And it is on page 60 in your book. But so this is showing us that our asset accounts, any account that's an asset account, increases with a debit. So if this is 0 and we want to increase our assets, we increase them on the left side of our T account. Moving to the left side. If this is a 0, we're moving away from the 0, so we're moving to the right to increase our liabilities. We're going to move to the right. So that means that liabilities increase with a credit. Equity increases with a credit. So the main thing, or I guess the first thing would be make sure you know what an asset is, what a liability is, and what an equity account is. And there are some examples in here that tell you, these are all assets. We looked at the balance sheet and income statement a second ago. So you're allowed to use your book to refer back. So I highly recommend you doing that. All right, so asset accounts increase with a debit on the left-hand side. Liabilities increase with a credit on the right side. Equity increases with a credit on the right side. To increase the cash account, a business would record a debit to cash. So here we are increasing our cash account by $30,000. So we're going to debit our cash account by $30,000. This is an asset account. And then to decrease the cash account, a business would record a credit. So we paid $20,000 out. We took that money out of our pocket, out of our bank account, and we paid it towards something. So we're going to credit our cash account by $20,000. This is our expanded accounting equation. So we see here we started with, assets equal liabilities plus equity. But in the expanded version, we're actually breaking equity out because equity has a little bit more involved in it. So within equity, you have your owner's capital account, owner withdrawals, revenues, and expenses. And we mentioned earlier on the board here that owner's capital increases with a credit. Owner withdrawals increase with a debit. Revenues increase with a credit. Expenses increase with a debit. So just note these, and this is the breakdown of the T accounts. So for equity, owner's capital would be added. Owner withdrawals would be subtracted. Revenues would be added. Expenses would be subtracted. But those all fall under equity. All right, so we're going to watch a quick video. Come on.
The secret of debits and credits. Let's start with our accounting equation. Assets equal liabilities plus owner's equity, and we know that both sides have to always stay the same, and whatever happens on one side, the same thing has to happen on the other side. We all should know that by now. And let's do this. Let's put a 0 up above that equal sign. And let's say that anytime that we want to reduce something on the asset side, we're going to go towards that 0. And anytime that we want to reduce something on the other side, on the liability owner's equity side, we're also going to go towards the 0. And let's also say that anytime on the liability owner's equity side that we want to increase one of these two elements, we want to move away from the 0 and go to the right. And that any time that we want to increase something on the asset side, we want to go away from the 0 to the right. So away from the 0 on either side is increasing, and towards the 0 on either side is decreasing. So let's go a little further. Here's a T account, and that's how we're going to explain debits and credits with T accounts. And all you need to know about T accounts are as follows. The debit means left. It doesn't mean plus or minus. It just means left. And credit means right. It doesn't mean plus or minus, just right. So anytime we're going to do a transaction, we're going to answer these three questions. First of all, what elements are affected? And elements are, there's only three: assets, liabilities, and owner's equity. That's the only three elements there are in accounting. So what elements are affected? Second question we're going to try to answer is what accounts are affected? And the third question we're going to try to answer is, did the accounts go up or down? So those are three questions we're always going to try to answer when we record a transaction using debits and credits. Now, let's suppose we start a business and we invest $5 cash. Here's the way you should record that. You would start with a cash account, which is going to be, we're going to have the element assets will be affected, and the account is cash, and cash is going to go up. And so if cash is going to go up, it's going to go away from the 0 sign, or it's going to go to the left. And the capital account is the other part of this transaction, and it's going to also increase. So cash is going to go up, and so is capital, and they're going to go up by $5. And so with the rules in mind we have up there with these arrows, then to increase an asset, you're going to go away from the 0, or you're going to go to the left side. And with the capital account, you're going to go away from the 0 on this side, and so you're going to go to the right. So that's the rule of debit and credit using these arrows, and that's our first transaction. Let's do 5 more of these.
All right. I hope that helps a little bit with understanding debits and credit. Let's see. Now we'll go back to our chapter. Because I will say this, it can be confusing, especially if you have like no accounting background at all. I want to say, I think debits and credits and T accounts were like the hardest for me in my first accounting class. I was like, what? Because I was thinking, back then, you have a checkbook and you balance your checkbook and you have the left side and the right side, and this is, you know, money going in and out and all. And I'm like, what? I'm like, why are you debiting cash when you're getting it? I was like, that doesn't make any sense. I was like, Debit means like subtract, right? I always would get so confused on that. And yeah, so, and then I saw this video and I was like, oh my gosh, that is genius. So ever since I saw this video, I'm like, just think of the equal as 0. If anyone has that same issue, this might help them. So hopefully that helps. But all right, so on the slides, we're on slide 18. There we go. And perfect. So all accounts are summarized on one side of the T account. And that side is the side of that T account's normal balance. An account's normal balance appears on the side that increases the account. So assets increase with a debit. So therefore, the normal balance of an asset account is a debit balance. Assets increase with a debit. So this is the normal balance for our asset accounts. An account, a liability and an equity account, both of those increase with a credit. So the normal balance for our liability and equity accounts would be a credit balance on the right-hand side. And then this gives us an actual breakdown of those accounts. And we have here, we've got the normal balance of an asset account. It says increases with a debit, decreases with a credit. So the normal balance for the asset account is a debit. Expenses. Expenses increase with a debit. They decrease with a credit. So the normal balance for an expense account is a debit. Dividends increase with debits, decrease with credits. Normal balance is a debit. Liabilities increase with credit, decrease with debit. Normal balance is a credit. Revenues increase with credit, decrease with debit. Normal balance is credit. Common stock increases with credit, decreases with debit. Common stock's normal balance is a credit. And an easy way to remember the rules of debits and credits is to memorize this information right here, this slide, if you can. Also, there's a little like mnemonic or little slogan that they have put in here in the book. And it says, all elephants do love rowdy children. All elephants do love rowdy children. So the first 3 words in the sentence will help you remember assets, expenses, and dividends. All elephants do. Assets, expenses, and dividends all have normal debit balances. And then the last 3 words, liabilities, revenues, and common stock, love rowdy children, those have normal credit balances. So if you remember, all elephants do love rowdy children, that might help you with remembering their normal balances, assets, expenses, dividends, debit, and liabilities, revenue, common stock, credit. That might help you. And that's on page 62. Yeah, I'll pull this one too. So we have one more video. Let's get this copied. And
This is a presentation on normal balances in accounting. Some accounts have debit balances, while other accounts have credit balances. Most learn about normal balances as they learn about debits and credits. So what increases an account? It depends on the account. Some accounts increase with debits, while other accounts increase with credits. So let's take a look at some accounts that increase with debits. Some accounts are asset accounts, some are expense accounts, and some are withdrawal accounts. Let's take a look at some asset accounts. Some examples of asset accounts are cash, accounts receivable, inventory, and equipment. We would say that cash normally has a debit balance. Let's take a look at some expense accounts. Some examples of expense accounts are rent, salaries, utilities, and insurance. Now let's take a look at some withdrawal accounts. Some examples are owner withdrawals, and in the case of corporations, dividends. Those were some examples of accounts that increase with debits. Let's take a look at accounts that increase with credits. Some accounts that increase with credits are revenue accounts, liability accounts, and capital accounts. Let's take a look at revenues first. Some examples of revenue accounts are sales, doctor fees, and interest income. We would say that sales normally has a credit balance. Let's look at some liability accounts. Some examples of liability accounts are accounts payable, accrued expenses, bank loan payable, and deferred revenue. And let's take a look at capital accounts. Some examples of capital accounts are owner contributions, and in the case of corporations, common shares. So those were some examples of accounts that increase with credits. So what increases an account? Well, in the case of asset accounts and withdrawal accounts and expense accounts, they increase with debits. Liability, capital, and revenue accounts increase with credits. And it works the other way too. Asset accounts, withdrawal accounts, and expense accounts decrease with credits, while liability, capital, and revenue accounts decrease with debits. So as a summary, cash is an asset account, so it has a debit balance normally. When cash is received in a business, the account cash is debited. When the business pays out cash, the account cash is credited. Sales is a revenue account, so it normally has a credit balance. When sales increase, the accountants credit the sales account. And if the sales account needs to be decreased, the account is debited. I hope you enjoyed the video.
All right. So that's a little bit more about normal balances. Let's see here. So we're going to determine the balance of a T account. So we're going to use the T account to determine if the ending balance in this account, the ending balance is shown on the side with the larger number. So whatever side of the T account has a larger number, that's where your balance is going to go. So we see here we're looking at the cash account. We have, so the balance of this cash account is $12,300. This is calculated by adding each side from the account separately. So we've got $35,500 and $23,200. Then we're going to subtract the smaller number from the larger number. So we're going to take the 35,500. We're going to subtract 23,200, and that leaves us with a remaining balance of 12,300. And that amount, the balance, is always reported on the side with the larger number. So the debit side had a total of 35,500. The credit side had a total of 23,200. The larger number is on the left, the debit side. So our balance is going to be on the left, the debit side. Does that make sense? Does anyone have questions? So so let's say this is the cash account as well. I don't know why I did that. I was going to put debit and credit, but let's see. This is our cash account as well. And the left side is the debit side. The right side is the credit side. We have $500 cash. Where am I going to put that 500?
Left side.
On the left side. So we have $500 cash on the first of the month. So on the first of the month, we have 500 cash. And then on the 5th of the month, we paid $300.
So turn to the right side.
So we're going to put 300. You have to know this for your T accounts. So good job so far. So on the 5th, we took 300 out. We credited it. And notice I didn't put it up here. Right? I didn't put it up here with, there's this open space right here, right? We had a debit of 500 on the 1st, but we didn't have any credits, so I didn't put any credits. Then on the 5th, we had a credit of 300, so I put the 300 here. So when you're filling out your T accounts, I know you have cells. You may end up not putting a number in that top cell for whatever that, in this example, for example. So now, what is our balance in our cash account?
200.
And what side does that go on? The left, 200. Because this is the larger number. And because cash has a normal balance on the left side. So I hope that helps a little bit. Does it? Okay. All right. So are there any other questions about this so far? T accounts, normal balances? No? Okay. All right. Does anybody need a break? Okay. All right. So we'll take a 5-minute break and we'll start back at 10:31. The clock just changed. All right. So 10:31, we'll start back.
anytime.
I think about it after I've already gotten too far away to catch it. So what do you do at the school?
I work with Director Moss as an assistant, so like that desk right there, I sit there.
Okay,
Yeah.
cool, awesome. Have you been here very long? Like working here very long?
No, I started, last month.
Okay, so you're new.
Yeah.
Did you already, you already attended here though? Is that correct? Yeah.
Yeah. But I did know like some accounting, like I said, I did have a business.
Mm-hmm.
So a lot of the stuff they were explaining me is just visualizing it. It's
Mm-hmm.
like, okay, now I see what's going on. So it
Yep.
was already like a little knowledge there.
And
I
it
did
might-
insurance,
Yeah.
so.
And a lot of times, I mean, it helps to do,
Mhm.
like to learn. And so already having that experience, this can kind of help you to pull it all together, like you're
Yeah.
saying. So
I was like, I've seen T charts and stuff, but it's like, what was I actually supposed to, but reading it and actually having it all, I was like, okay,
yeah,
that makes so much sense.
very good. All right. So we are going to jump in objective 2.3. Record transactions in a journal and post journal entries to the ledger. So how do you record transactions? Accountants use source documents to provide evidence and data for recording transactions. The documents help businesses to determine how to record the transactions. And this is some examples of source documents. So other source documents include purchase invoices, bank checks, and sales invoices. In this example here, they're showing us how accounting data flows, the typical flow of accounting data. And so on page 63 in your book, it also shows the same diagram. So first, we have a transaction that takes place. So a transaction has occurred. Once that transaction takes place, source documents are prepared. So when a sale is made, there may be a purchase order or an invoice. The transaction is then analyzed, and then after the transaction's analyzed, then transaction is journalized and posted. Which is in your assessment. Let me make sure I tell you the right requirement. Let me see here. Yeah, so requirement 3. So requirement 3. All right, so journaling. Keep that in mind as we're talking about journaling. So journaling and posting transactions. After reviewing source documents, accountants record the transactions. Transactions are recorded in a journal. A journal is the record of the transactions in date order. And transferring data from the journal to the ledger is called posting. I have you sign in real quick so that we don't miss you. No problem. I'll get you marked in. Perfect. All right, so here we have an example. We have a transaction. And if you look in your book on page 65, that's where the data for this particular slide is coming from. So here we have a transaction, stockholder contribution. On November 1st, the e-learning company received $30,000 cash from Sheena Bright. The business issued common stock to her. So step one, we need to identify the accounts and the type of the account. So the two accounts that are involved are cash and common stock. Cash is an asset account and common stock is an equity account. Then, so we've identified our two accounts and the types of accounts that they are. So now we need to decide whether each account is going to increase or decrease based on what they've told us. So they told us that the company received $30,000 cash. So is cash going to increase or decrease?
Increase.
So our company received $30,000 cash. So is cash going to increase or decrease?
Increase.
Cash is going to increase. And then we received it from Sheena Bright, and we issued capital to her. And we said here, we identified that common stock capital, we issued capital to her. So common stock is going to be the account that's affected. And that is
Credit.
we're gonna credit that account to increase that account as well. So when we look down here at our extended accounting equation, assets went up, cash is an asset account, and cash increased in this example because we received cash. We got more cash, cash increased. So because cash increased, we are going to debit our asset account to increase our assets. Common stock is an equity account that is also increasing. To increase our equity account, we are going to credit common stock. Because earlier we mentioned to increase assets, you increase them moving left. So assets increase with a debit. To increase liabilities or equity, you increase those to the right. So liabilities and equity increase with a credit. So then in step 3, we're going to record the transaction in the journal. So the transaction, what happened? Our e-learning company received $30,000 cash from Sheena Bright, and the business issued common stock to her. So in our journal, first we're going to start with the date. So this happened on November 1st, and this is all on page 65 in your book. So it says on November 1st. So on November 1st, that's our date. So we're going to put our date in here. And what happened? What two accounts did we identify? We identified cash and common stock. We mentioned earlier, cash is normally what? It is normally always listed first.
Liquid.
Oh, yep, sorry. Yeah,
Yeah.
you're on the right track. Cash is always listed first, right? So we're going to put cash in the top. Well, in this example, the debits are listed first. In your journal entries, whatever's debited is listed first. I apologize for that. So whatever account is being debited is listed first, and a way to remember that is this is the left-hand side of the account. So all your debits will be listed first, and then all of your credits will be listed second. Another thing, if you notice there's an indentation here. So we debited cash and then we credited common stock. So we're going to indent a little bit. We're going to push this over to the right just a tad for common stock, and then we put this into the credit. So and the reason I'm talking about that is because you're doing this in requirement 3 of your assessment. So in requirement 3 of your assessment, you'll see you're going to have a debit to something, and it needs to look like this. And then when you credit the other account, just indent, space bar, whatever you need to do to make a little bit of space here, and then put that account name and then the amount that's being credited. So the debit account name for this example is cash, and the debit dollar amount is $30,000. And then the other account that was affected was common stock. So the credit account name and the dollar amount. The credit account name is common stock, and that is indented. And then you put the credit amount on the credit side. And then the last piece of the journal entry, you will write a brief explanation. So in this example, what happened was we issued common stock. So we're just going to put in a little note here letting them know that we issued common stock. The reason that we do this, people start jobs, they move up, they go somewhere else, and it could be a year from now, 2 years from now, 5 years from now, who knows, it could be next month. But I'm sure that all of you have probably, maybe, possibly started a job, and maybe you couldn't figure out what in the world the person that worked in this job did before you. Like, not what they did, but how they did something. Like, maybe you looked at some work that they had done, or maybe you're just trying to find something. Maybe you're trying to find some information and you can't find it. And it could even be like, maybe it's filing systems, like actual paper files. And you're like, they keep telling me it's supposed to be in this big file somewhere, but I have no clue where it is. And maybe it was something as small as they named it something different, and you were looking for one name and they named it something else. But the point of this journal entry, putting the date, making sure that you put this note here, is so that hopefully if someone has to find this journal later, they can find it and they will know what's going on. In some cases, the note may even be more detailed than this, and they may actually put in the note, issued common stock to Sheena Bray. But for the purposes of this class, all you need to do is just put in a brief explanation. I'm just letting you know that if you ever work in accounting or an accounting related job, I mean, you could be a manager, a business manager, anything, then you may see some more in-depth explanations than this one. But for the purposes of this class, just something brief and small is perfectly fine. And when you are working on your assessment, it's not going to be in there. You'll have the date, you'll put in the account, the 2 accounts that are affected, and then you will also add in a posting reference, which they don't have here, and I think that's because we're doing single transactions. In our assessment, we have multiple transactions that we're working with. But if this one had a posting reference, the posting reference would actually be right here. So there would be a column here for posting reference, and you would put whatever that posting reference was. So if this transaction's posting reference was A, you would put A right there. And it's going to only reference one scenario. So you would only put an A there. You don't have to put an A on the next line for common stock. You can just put it here in this first line. Because this is what your assessment journal entries will look like. They will have a posting reference column and then a letter. I already closed it, but right here in requirement 3. So you'd have, I would say like November 1, and then you would have cash. What was it, common? They had it as common. Oh wait, I'm not even on the right slide over here. Yeah, common stock. So then right here, you would just space over a little bit and put common stock. And then the posting reference, we mentioned it would be A. This is just an example. And they debited it for 30,000 and credited it for 30,000. So this is what your journal entry would look like in your assessment. And then the note was issued common stock. And you can add that note. Now, in the assessment, though, they do not have notes for requirement 3. So for requirement 3, this is really all you have to worry about for each journal entry. And there are a few. There's multiple journal entries. So you'll have multiple entries listed out here. But this is the layout of how that would look based on this example that we're working on. Does anyone have any questions so far? Okay. All right. So we have our journal entry, and now we're going to look at our T accounts. We've written out our journal entry here. So we know that the 2 accounts affected are cash and common stock. So we're going to look at our cash T account and our common stock T account. We're going to debit our cash T account by 30,000, and that happened on November 1st. And since we debited, it happened on the left side. So our date is going to be on the left-hand side. We're going to credit our common stock. Since we credited, it goes on the right, and our date is going to go on the right side. So just note that as well. So basically, it's kind of like you're saying that, you know, you have, this is your T account, this is where your T account information goes. If you're thinking of Excel, you have cells that you're working with, right? So this is a cell, this is a cell. So when something takes place, you could think of this left side as being like your notes or your date side. So you're going to put anything that happens on the left side, those notes or dates will fall on the left side. And anything that happens on the right side, those will fall on the right side. So if we had 30,000 cash and then we had a credit for $5 on, that's supposed to be a 5. We had a credit for $5 on November the 2nd, then we would put November 2nd right here. I'm writing with a mouse, so so that's how that would work, just to kind of, you know, give you a little more. So for transaction 2, so now we have purchased land. So on November 2nd, Smart Touch Learning paid $20,000 cash for land. So what are we going to do? We paid out $20,000. So first we need to identify the accounts and the account type. The 2 accounts that were involved are cash, which is an asset, and land, which is an asset. So we have 2 asset accounts that are involved. Then we need to decide whether each account increases or decreases, and then apply the rules of debits and credits. So we paid $20,000 out, so our cash went up or down?
Yeah.
Cash went down, money went out. So we're down $20,000. So our cash went down, which is an asset. Assets decrease with a credit. We received $20,000 in land. So land is an asset, but land went up. So we debit $20,000 for land. So when we're writing out our journal, again, we put the debit first. So land was debited 20,000, and then cash was credited 20,000. And the note is that we paid cash for land. And then we buy $500 of office supplies on account. On account is like on credit, right? We bought it on account, so we have not yet paid the cash out. So that means we're going to have an account payable. So we receive the supplies. Supplies increases with a debit because it's an asset. Accounts payable is what type of account? Is it an asset, liability, equity? Accounts payable. Liability. So accounts payable is increasing. It's a liability, but it increases with a credit. And so we're going to debit office supplies by 500, credit accounts payable by 500, and our note is that we purchased office supplies on account. On November 8th, Smart Touch Learning collected cash of $5,500 for service revenue that the business earned by providing services for clients. So we collected cash. We're going to debit cash for $5,500. We're going to credit service revenue for $5,500. And we performed services and we received cash for those services performed. And then on November 10th, Smart Touch Learning performed services for clients for which the clients will pay the company later. So we already performed the services, but we have not yet been paid for these services yet. The business earned $3,000 of service revenue on account. So we have our date. We're going to debit our accounts receivable for $3,000, and we're going to credit our service revenue for $3,000, and we performed services on account. So we've earned the money, but they have not yet paid us for it. That's why we have a receivable. It's money owed to us. And then Smart Touch Learning paid cash expenses on November 15th, $2,000 for office rent and $1,200 for employees' salaries. So we have a couple things going on here. All right, so on November 15th, both rent expense and salaries expense involved cash. So because they both involved cash, we can list this as one single journal entry. If you noticed, for example, all of the journal entries we've been looking at so far, it's only 2 lines, debit and credit. This one, we have 3 lines. And that's okay because these accounts, at least one of these accounts involves another account that is being used in this journal entry, which is what? The cash account. So both our rent expense and our salaries expense have something that is moving to cash or out of cash. Our rent expense. So we paid cash expenses. We paid cash out. How do we decrease cash? If we paid cash out, how did we decrease it? Are we going to debit it or credit it? We're going to credit it. So we know that we're going to credit cash for the total amount, which is $3,200. And that means, therefore, the other 2 have to be debits, right? So if you ever get confused and you see something like this, I always tell people, if you know your assets, because the asset accounts are normally the easier ones to memorize, I guess. If you know your assets, and you get stuck on a question, identify the asset accounts first, and then you might be able to figure it out if you don't know the other accounts. So we know that we're crediting cash by $3,200. So we're going to debit the other 2 accounts. rent expense for $2,000, salaries expense for $1,200, and our note is that we paid cash expenses. A journal entry with more than 2 accounts is called a compound journal entry. So this is a compound journal entry. On November 21st, Smart Touch Learning paid $300 on the accounts payable that was created in our transaction number 3. So we're going to go in, and on November 21st, we're going to debit accounts payable for the $300, and we're going to credit cash for the $300, and our note is that we paid cash on account. And then on November 22nd, Smart Touch Learning collected $2,000 cash from a client that happened in transaction 5. So we're going to go in and we're going to record on November 22nd that we debited cash of $2,000. We credited accounts receivable of $2,000, and our note is that we received cash on account. On November 25th, a payment of $5,000 cash was paid for dividends. So we're going to go in and we're going to debit dividends for $5,000, credit cash for $5,000, and our note is that we paid dividends. And then on December 10th, we have prepaid expenses. On December 1st, transaction 10. So Smart Touch Learning prepays 3 months office rent. So we paid our rent in advance for 3 months on December 1st. So we're going to debit our prepaid rent for $3,000, and we're going to credit our cash account for $3,000 because our prepaid rent and our cash account. And then in our prepaid rent, we're going to put in our note that we prepaid rent in advance. On December 1st, we paid employee salaries of $1,200. So we're going to go in and we're going to debit our salaries expense, and we're going to credit our cash account. And then the note is just that we paid salaries. On December 1st, we purchased a $60,000 building in exchange for a note payable. So we're going to debit the building for $60,000 because this is an asset account. Buildings are assets. And we're going to credit our notes payable for $60,000. That's a liability. And our note is that we purchased a building with a note. And then we received a contribution of furniture. So Sheena Bright gave us furniture to use in our office. The fair market value of that furniture was $18,000. So we're going to debit furniture, which is an asset, by $18,000 to increase that. And we're going to credit our common stock by $18,000 because she's one of the owners. So Sheena Bright donated $18,000. So there was a contribution of furniture in exchange for common stock. She gave us furniture, we gave her common stock in the business. On December 5th, Smart Touch Learning received a telephone bill for $100, and we're going to pay this next month. So we have the expense of the telephone bill, utilities expense, we're going to debit by $100 because we received the bill for it. It's being expensed, but we're not paying it yet. We're going to wait and pay it later. So we're also going to have to increase our utilities payable account. It's a payable, so it's a liability. We owe it. So to increase liabilities, we increase those with a credit. So credit $100, we have an accrued utility liability. On December 15th, Smart Touch Learning paid employee salaries of $1,200. So December 15th, debit salaries expense for $1,200, credit cash because we paid it for $1,200, and our note is that we paid salaries. And then on December 21st, a law firm engaged Smart Touch Learning to provide e-learning services and agreed to pay $600 in advance. So December 21st, we debit cash for $6,000. We credit our unearned revenue for $6,000. And the note is collected cash for future services. On December 28th, Smart Touch Learning collected cash of $8,000 for service revenue that the business earned by providing e-learning services for clients. So we're going to, on December 28th, we're going to debit cash for $8,000. We're going to credit service revenue for $8,000. And our note is that we performed services and received cash. That is the last transaction in this set of examples. These will be very good for you to go back and look at when you are performing your journal entries for requirement 3, because these are examples of what the journal entries look like. You may even find some examples that use the same exact accounts as the accounts that you're using in your assessment. So it'll definitely help you. Also in the book, if you're looking at the book shows you how the T account is affected when this transaction takes place. So for example, I mean, and this is on any of the transactions, but if you look at the very last transaction on page 75, transaction 17, if you look at the T account for cash, you can see all of the transactions that we just went through that dealt with the cash account. And you'll see how they showed that on the T account. So on the T account, we have November 1, 30,000, November 2, 20,000, November 8th, 5,500, November 15th, 3,200. So they list out the amount. They put it either on the debit or credit side, depending on if it's a debit or a credit. And they also put the date that occurred next to that amount as well. So this is definitely a good spot for you to go back and reference. And then if you look on page 76, 76 just shows you all of the T accounts together. So you can go there as well and see all of the different T accounts and how they were affected. Do you have any questions about this so far? Okay. All right. We will continue. All right. So the ledger accounts after posting. So we've posted our journal entries. We noticed that if we look in the book, we notice that the total assets of, on page 76, we notice that the total assets equal $114,700, and that our total liabilities equal $60,900, and our total equity equals $53,800. So when we add these together, we have liabilities, our total liabilities plus equity. So the $60,009 plus the $53,800 right here equals $114,700. So that means that both sides will balance, right? Our assets equal our liabilities plus our equity. So when we go to this next slide, this is the slide that we're referring to. Can you see that? So it's also in the book, but this $1,014,700 equals the $60,900 plus the $53,800. Assets have to equal liabilities plus equity. They have to balance. If they don't balance, something's off, something's wrong, and you need to go back and figure out what it is. So the 4-column account, this is an alternative to the T account. If we look on page 77, you can also see it there as well. But so the 4-column account, this is also very similar to your assessment, right? So here we have, here though, we're just looking at the cash account. So we're just looking at the cash account, and we've broken down all of the different dates or transactions that have occurred in the cash account. So in November 1st, we had a debit for this amount here. November 2nd, we had a credit for this amount here. And then we're going to list out the balance in that account after each transaction. So we started with 30,000, debit 30,000, debit 30,000. Then we had a credit of 20,000. So the difference of the 30 and the 20 is 10. So now our balance in this account is a debit of 10,000. Then we increased 5,500. So now our balance is 15,500. So that's how this works. The debit so we have either the debit or credit for each transaction listed here. And then the balance of the account after each transaction occurs is listed here. And then posting references. We mentioned this earlier as well, and you'll have some references that you have to put in your assessment. But this is our posting reference right here, and the assessment does look like this. So we've got our date, we've got our journal entry, we've got our posting reference, and then we've got the amount that was debited, the amount that was credited. So this is the page. This is the account number right here. So we've got the account number listed here. We saw that earlier, right? When we were looking at our chart of accounts earlier, we noticed that the cash account was 101. So this is our account number, 101. And then this is the account number for the Bright Capital, which is 301. The posting reference here, this is the page number from the journal. So J journal, and then 1, this is journal number 1, or journal number 1. So that's just telling you where that posting reference is coming from. Page number and the journal number. The account number comes from the ledger. Does anyone have any questions on any of this so far? Not yet? Okay. All right, so we're going to prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. Use this to complete the assessment. All right, so here's an example of a trial balance. A trial balance is a list of the ledger accounts with their balances at a point in time. The asset accounts are listed first, followed by liabilities and then equity. So we've got our trial balance here. All of our asset accounts are listed first, followed by our liability accounts, and then our equity accounts. These are financial statements. Do this. Come on. Oh, it already is. Okay, trying to make this a little bit bigger, but so our financial statements, we have our income statement, statement of owner's equity, and balance sheet, and this is on page 80. So for the income statement, we said what accounts are listed on our income statements? Do what? Our income statement, what accounts do we see on our income statement?
Service revenue.
Yes, both of you are correct. Revenues and expenses, service revenue is on there, salaries expense, rent expense, utilities expense. So our income statement, this shows all of our revenues and all of our expenses. And so we see examples of those accounts here. And then on our statement of retained earnings, on the statement of retained earnings, this statement pulls from our income statement. So when we are working on our assessment, if our income statement is incorrect, our statement of retained earnings will also be incorrect. And you're graded on each of these individually. So you want to make sure that you, if you see anything that looks off, definitely go back and double check that. So our income statement, the net income flows from the income statement to our statement of retained earnings. And then we subtract out our dividends, which gives us our retained earnings. Our retained earnings flows to our balance sheet. So if our retained earnings is off, then our balance sheet is going to be off. When we get to the balance sheet, we have our assets. Notice this is laid out as very similar to the accounting equation. So we have all of our assets listed to the left-hand side of the balance sheet. And then we have all of our liabilities and equity accounts listed on the right-hand side of the balance sheet. Left and right have to equal. Assets have to equal liabilities plus equity. So once we total up all of our asset accounts and we total up all of our liability and equity accounts, these have to equal. And if they don't equal, then you know you need to go look at something, right? The first thing to look at would be something in your balance sheet. But let's say you look here and everything looks good in your balance sheet. You're like, no, I'm pretty sure this is right. Well, then that means that maybe the amount you brought over from your statement of owner's equity is off. So then you're going to move from the balance sheet to owner's equity. And you're like, well, no, because that was the amount of the owner's withdrawal. So that's got to be correct based on the math that I have here. Well, what feeds into this report? The income statement. So then you're going to have to go back and look at your income statement. And then you're like, oh man, okay, I forgot that we paid that salaries expense. So that went down, or something like that. And then so the issue could be in any of these reports. So that's why it's very important to try to make sure that you catch these as soon as possible. And that's also why we talk about and review and work on our assessments in class in the morning. So just to kind of make sure that we're all on the same track and everything. Because you do have to create these reports for the assessment. Does anyone have any questions so far on these? Okay. All right. Correcting errors. I mentioned this, but we'll talk about it again. This is a really good slide too. It's actually in a slide for you on slide 53. But if there is an error in your trial balance, so this is the unadjusted trial balance that we have for our assessment. Notice that the totals are different. We have not adjusted this, so they're going to be different. This is just what we have right now before we go in and adjust for changes that have taken place during the period that we are looking at. This is unadjusted. That's where all those unadjusted changes, that's where all that unadjusted initial information goes. Then we're going to add in whatever adjustments took place. So on the adjusted trial balance, that's what we're talking about right now. Okay, so we're talking about these columns right here, adjusted trial balance. Trial balance errors. So if you have an error in your trial balance, if you're on your total line and this total is 500 and this total is 600, and you're like, okay, well, they're supposed to both be 600, or you don't even know that, okay? You don't even know that they're what they're supposed to be. You just know that they don't equal, right? Because they're supposed to both equal. So A is supposed to equal A. Both of these are supposed to equal, and they don't. 500 and 600 do not equal. So we know that there is an issue somewhere in here. We have put something in here that is not correct. That's what this slide is trying to tell you how to fix or find. So you're going to search for the missing accounts or errors. So does it happen to be, maybe you just go back and you read your instructions and you just skipped something, right? You could have skipped a transaction. And then once you add that transaction in, now debits and credits will equal. If that's not the case and you didn't miss something, another thing you can do is you can divide the difference between your total debits and your total credits by 2, meaning that you would take the 500 plus 600, that's the total, and then you would divide that by 2, which gives you 550, and they're telling you to then look for 550. A lot of times, you'll be able to find that number somewhere in here, either on the debit or credit side, if you only have one account that is affected. If it's a multiple accounts, that's not going to work. But that is a quick way, it's a quick little calculation, and a lot of times it will work because maybe it's even just like a typo. Maybe you accidentally miskeyed something. So a lot of times it will help you to identify the account that is in question. If that doesn't work, you can also divide the out of balance amount by 9. Well, this is another way that you can do it. You can divide the out of balance amount by 9 to find transposition errors, like miskeys and typos and stuff like that. So you would just divide it by 9. So you would say, okay, well, I'm out of balance by $100 and divide that by 9 and see what number that comes up with. And then you can look to see if you see that number anywhere in here. That normally helps us to identify errors. Again, if there's multiple accounts involved, you'll have to do a lot of digging. So, are there any questions about that? No? Okay. All right. Learning objective 2.5. So we're going to use the debt ratio to evaluate business performance. And this is on page 81. So the debt ratio shows the proportion of assets that are financed with debt. It can be used to evaluate a business's ability to pay its debts and to determine if the company has too much debt to be considered financially healthy. So the formula to find your debt ratio is to take your total liabilities divided by your total assets. And again, this helps to show the proportion of assets that are financed with debt. So why do you think we have a debt ratio, or who do you think uses the debt ratio?
Loans.
Yep, like creditors and stuff. Like, do I want to issue money to this business or not? What is your debt ratio? And even personal, right? Like when you're looking to buy a house, they put you through so much stuff. It's crazy. I was like, man, I should just stick to renting. But they look at everything. They're like, oh, you got to pay these credit cards down and all this stuff before you can do this and that and whatever. And then, oh my goodness, they look at all that stuff though, debt and liabilities. So it's very important to try to make sure that your debt ratio is low if possible. Companies that have a high percentage of liabilities are at greater risk of default. So the more liabilities you have, the more at risk you are to default. So do you think creditors will be more likely to want to lend you money if you have a lot of liabilities? Probably not. Because, you know, at the end of the day, creditors are loaning money out to businesses or people expecting to make money off of that. And if you have a lot of liabilities already, in their word, you might not be able to pay your liabilities, then that means you might not be able to pay them. So just keep that in mind. And then, let's see, the debt ratio calculates the percentage of assets that are financed with liabilities. So it's letting us know how much asset is financed with liabilities. Are there any questions about that? No? Okay. So let's see. I am going to go back. Hold on. I want to go back to our assessment. So we talked about T accounts, the worksheet, preparing adjusting entries, preparing the trial balance. We have looked at the income statement, statement of retained earnings. Let's see. So that's the requirement 4 is where you create your adjusted trial balance. Requirement 5. There, I'll pull it up on here. So you're going to create your adjusted trial balance here, which you can do now. You can create your income statement, your statement of retained earnings, and your balance sheet. You can create your journals and your T accounts. So you can do everything in your assessment. Well, okay, you can do the whole assessment if you choose to read and stuff and go further than us. But as far as what we have covered in class so far, you can do all the way up to requirement 6. Requirement 6 well, hold on. I think these are closing. Yeah. Prepare closing entries. Okay. No. Okay. So you can do all the way up to requirement 5. We have not talked about closing entries yet. You could go ahead and create their T accounts because these are the initial T accounts, right? Cash, we started with how much? What was cash?
16,900.
Okay. So we started with this in cash. So requirement 1, this is what we're doing for all of our T accounts, right? If we have a balance there, we're putting the balance in the T account. And then if it's a debit balance, we'll put it on the left. If it's a credit balance, we put it on the right. That's all we do for this requirement 1. And this is the assessment, Jordan. So I'm just making sure that I'm kind of like going through it a little quickly because they've already been through it twice. But trying to be a little more in depth in a sense because he hasn't been through it at all. Yeah, because I was like, wait, twice, this is our second class, but we did it this morning. So this is step 1. You're doing your initial balances in your T accounts. Once you have those in there, you can copy this, right? So you can just copy all of the T accounts that you have, and then you can paste them here because the beginning balance is going to stay the same. And so we still have the 16,900 in cash right here, right? But now for requirement 3, we had some adjustments that happened, and we listed the adjustment information in our adjustment column here. So for requirement 3, we're going to add some amounts to some of the T accounts to show the adjustment. Once we have completed all of that, you can copy all this again and paste it right here. And then after you complete requirements 4 and 5, you are able to go in and do this if you choose to. These are for like I'm talking about this for like the people that are just like, I'm just going to get this done so I don't have to think about it anymore. So you can technically get all of this done. I mean, you could technically do your closing and journal entries, but you would have to read ahead, and we haven't talked about those yet. But if you wanted to go ahead and attempt it, you can. But you should be able to do everything up to requirement 5, which, let's see. Is next class, so it's next class, but you can do it now if you choose to. We'll talk about it. We can talk about it next class as well. So.
Okay, the assessment is due next week?
No. Requirements 4 and 5 are next week. But you can do all of them now if you choose to. Let's see here. You also can do your income statement and your balance sheet. So remember, once you make your adjustments here, you will then add or subtract. So let's say this is cash, and we had $1,000 in cash. We paid out $500. So then we had an initial debit of $1,000. We paid out, we credited $500. So the difference of these two numbers is $500. And is the higher number in the debit column or the credit column? The debit column. So we're going to put $500 debit in our adjusted trial balance. We also went through all of these accounts earlier, and we identified that the first set of accounts are income statement or balance sheet?
Balance sheet.
Balance sheet accounts. And the second set are income statement accounts. So when you are over here filling out your income statement and your balance sheet, keep in mind that the first set of accounts were income statement and the second set were balance sheet. So when you go over here and you create your income statement, you're pulling only your income statement accounts in. So you're only pulling your revenues and expenses. So this is your income statement. So you're only going to pull, sorry, I think I highlighted that wrong. Your income statement accounts. This is where your revenues and expenses were. So you would just copy that over and then make sure that you have it set up properly based on the examples in the book. Because, for example, you normally have one revenue account, but sometimes you'll have multiple expense accounts, right? So what are some expense accounts? Salaries expense, rent expense. So yes, so those are all types of expenses. So you may have that. You may have a salary expense account and a rent expense account. So just note that you're going to list those out. And then you'll put whatever the amount was for each of those accounts. So, and then this would be what your revenue account. So normally that's service revenue. So we have service revenue of $3,000. And then we have salaries expense of $300, and we have rent expense of $500. So then you're gonna have your totals down here. So how would we complete this? Remember last week I talked about how we have, so this is kind of like your total column. If you only have one, so your revenue, whatever the total of your revenue is, will be listed here. And we only have one account in revenue, that's service revenue. So the total revenue, the total service revenue is 3,000. So that's why we put that here on the right-hand side. This is not a debit or a credit thing right here. We're talking about an income statement. I just want to point that out. I don't want you to think, don't think debits and credits right now. This is the income statement. So then for expenses, well, we don't just have one expense account listed. We have salaries expense and we have rent expense. So we're not going to put 300 and 500. We have to add them up. Correct. So we have our salaries expense account and the total amount that is in our salaries expense account. And then we have our rent expense account and the total amount that is in our rent expense account. But then we're going to add these to get the total expenses. And the total expenses is $800 in this example. So our total expenses for expenses is $800. And now we need to find our net income. So how do we find our net income? What's the formula for that?
Revenue minus equity.
Close. Revenue minus expenses.
Okay, yeah.
They're both E's. So to find your net income, you take revenue minus expenses. So we have our total revenue of 3,000. Our total expenses is 800. So our revenue of 3,000 minus our expenses of 800. So our net income in this example would be 2,200. And that's your income statement. You can do that. You can also do your retained earnings as well. So remember when we talked about the statement of retained earnings, I said something flows into your retained earnings. So what flows into that account? So look at all the accounts in our statement of retained earnings. What accounts do we see here? We have retained earnings, net income, dividends. So do any of these look familiar from our income statement? Which one comes from our income statement?
Dividend.
So on our income statement, we have revenue, expenses, total expenses, and net income. One of these flow. So our net income from our income statement is going to flow through to our statement of retained earnings. So we're going to take this net income number here and we're going to put it in right here. So this flows through. So if this is not right, that's not going to be right. But so now we have our net income. And then the only thing we have to do on our statement of retained earnings is just figure out what the dividends amount was. So what amount went to dividends or out of dividends. So we'll figure that amount out. We'll put that there. Let's say that we have negative 200 for dividends. So now what is the balance in our retained earnings as of December 31st? 2,000, correct. So 2,000. So that's what we have here. And then for our balance sheet. So how will we fill out our balance sheet?
We'll take everything from like the assets and then list them in there from like cash, so on and so forth, and liabilities, and then the equities.
So we'll copy over our assets from here, from requirement 2. So just make note, in requirement 5, you're going to copy, income statement and balance sheet. So now we're talking about our balance sheet. So we're going to copy all of our assets over, our liabilities. We're going to copy that information over here. So our current assets, so we know that one of our asset accounts was cash. So in this example, we have cash for, and we're going to use the adjusted balance, right? We're using the adjusted balance. The adjusted balance, we copied it over. So we're going to, once we complete all of this, we will then just copy it over to the appropriate statement. So we would copy that over to here because cash is a balance sheet account. So now we currently have an adjusted balance of $500 debit in our cash account. So when we go to requirement 5, we would list out our cash account. So we've got cash and we had 500. And then we would list out whatever the other asset accounts were here. So this asset. And then our total, we would add these up and we would put the total here. So if this was 150, then our total current assets would be all of that added together. So you're just going to add these. There. And so that would be your total assets. So you'll just add all those up and then that gives you your total. So sub account, like all the single accounts listed here and their amounts, then you add all that up and you put the actual total here. You'll do the same thing for your plant assets. So if you have any plant assets, and then you're going to take the final total of assets and put it here. So it would be the 650 plus whatever your plant assets are equals your total assets. And that would give you your total assets. Current liabilities, you'll do the same way. So you'll have a couple of accounts listed out here. You'll add those together. Then you'll put down what your total liabilities was. Stockholders' equity, same thing. So for your stockholders' equity, you'll have your total stockholders' equity here. You have your total liabilities and stockholders' equity. You're gonna add in whatever other accounts are affected. So you're gonna add in some accounts here. Now, when we talked earlier about the income statement, statement of retained earnings, and balance sheet, we said your income statement, net income flows into your statement of retained earnings. And then from your statement of retained earnings, your final retained earnings will flow into your balance sheet. Does anyone know where the retained earning goes on the balance sheet? And there are some examples in the book. This example, for example, is on page 80, where it shows us our income statement, our statement of retained earnings, and our balance sheet, page 80. Equity. So our retained earnings is going to flow from the retained earnings to our balance sheet in the equity account. And the account is going to be called retained earnings. So we will have an account over here called retained earnings. And that is going to be the retained earnings amount of $2,000. So how do I do this? There we go. right here. So just note that. So your net income flows through to here, and then after you take out your dividends, you're left with your retained earnings. Your retained earnings flows through to here. So just know that you can do all of this now. So like I said, you can do up to requirement 5 now. You should be able to do it fairly, not fairly easy. I know this is new for you guys, but you should be able to get all of it done based on what we've covered so far. Do y'all have any questions about any of this? Okay. I'm sorry, what? Oh, okay. Just a review? Okay. Well, all right, let's see. We can spend the next 15 minutes working on our assessments. If you do have any questions about it, let me know. I know you don't have time to work on anything else because we've only got 15 minutes. But yeah, if you want to work on your assessment for the next 15 minutes, let me know if you have any questions at all. And then, let's see. Yeah, let me know if you have any questions. Jordan, do you have any questions regarding this? Because I know you weren't here last Saturday.
I need to review it and I just emailed you if I didn't know something, if I understood something.
Okay. And I feel like we kind of covered most of it again because I kind of circled back a little bit, but just know that it is, so I grade it, but it also goes up to like the higher ups. They look at the assessment as well. So it's a very big deal that you get it right. And so that's why we're going to spend some time in class in the mornings on it. If we have some time in the afternoons, like right now, we've got like 15 minutes, 10 minutes, because it is very important, because you can pass the whole entire class, but if your assessment is just way off, then because your assessment is assessing whether everything that you've learned in the class and how you can apply it. So if it's all, they can go back and say, well, no, this person needs to take this class again. Straight A's, but the assessment is just crazy. So just be very cautious of that. Another thing that I told them last week, and I tell everybody in my class this ever since it happened, but please only use your work. Don't use anyone else's work. I'm not saying that you will, I'm not saying that any of you will, but I did have a student that turned in an assessment and they left someone else's name on it. So just please do your own work. With the assessment, they give us the starting data and then they tell us what our adjustments are. And then these are the list of requirements for each requirement, what we have to do for those. The template is here. Do not change the name of the template. Try to keep the template as close to its original layout as possible. You can use formulas if you want to. You could even, instead of copying and pasting this, if you wanted to, you could even go in and put like an equals and take it back to like here. And then just drag that, you could, drag that formula all the way down. And then as you go through and you make changes, it would automatically populate it for you here. If you wanted, if you were like an Excel guru, you could do that. Formulas don't mess up the file. It's when people start adding columns and rows that it can get corrupted. And we've had some where like the files are corrupted and we can't see it and we can't grade it, and it's just like really like a nightmare. Because we're having to go back and forth between phones and emails and Moodle and back and forth with students. And it's always right around when grades are due. So it's like a disaster. But that's how you would do that. If you have not been able, I know that, were you dropped and then re-added? Yeah. Okay, so I'll, did you check to see if what you had done was on there?
Yeah, I didn't see the participation quiz.
Okay. Um, Did anyone else see the participation quiz?
I'm still waiting to get on, like, I'm still waiting to get like reaccepted. So,
Okay.
yeah.
Let's see. Because I don't think, let's see, I don't think that one was there for this class. I don't think that was one of the, but are you able to see like the chapter information?
Mhm.
Like chapter 1 homework and quizzes?
I can see all that except the participation thing.
Okay, perfect. And real quick, I'm going to just run through the attendance one more time to make sure that I have everyone on here. I think I went back and forth, but I just want to double check. So, Ido,
Yeah.
perfect. And Jordan, and Christian, okay. Ladisha, Naya, Nia. See, I was going to say Nia, but then because I said Ladisha wrong, I was like, well, I'll say, so Nia. And then my daughter has a friend, spells it the same way, and her name is Naya, but I was going to pronounce it Nia.
Yeah, it's always 50-50.
And then Christina and Luann, no. And then Amaru. Right after I said it, I was trying to fix it before you corrected me.
Usually don't,
Like,
like,
no.
just go to another room or something like that.
Do what?
No, like usually people don't like get it right on the first time. They kind of just like go like a main room
Uh-huh.
and so I correct them. So
Yeah, just you can correct me as many times. I actually had, and that's another thing. My daughter has a friend named Amara, and so that's why I was like Amaru, because Amara is spelled the same way but with an A at the end. So Amaru. Amaru. Well, you can call me Miss Gividan, which is not how you pronounce my name. It's okay.
How do you actually pronounce it?
I'll get it. It's Jividon, like with a J, but it's really Jividon. And I'm not, it's my husband's name, it's not me. Yeah. Yeah. We don't tell any, well, I don't pronounce it like that to anyone except for my kid who like always, she's like, how do you pronounce our letter? Because she thinks it's so cool and fancy. And I'm like, girl, we don't really say that here, but it does sound cool to a 7-year-old.
You gotta dumb it down for American language.
But that's the thing, like, it's so like pretty the way that other people, like, that's why I was like, oh, where's this accent from? Or where's this accent from? I just have like, this normal, I don't even have a Southern accent from what I'm told. I'm told I don't even sound like a Southern person, even though I was born and raised down here. But I mean, maybe because I went to school in Atlanta and it's so diverse that, I don't know. Like, I don't even have a country accent. I'm like, no. But do any of y'all have any questions, or have you run into anything since you were looking at the assessment or anything else? No? Okay. Well, if you do, feel free to email. I also opened a Chapter 2 discussion box if you happen to have any questions. If you have the question, someone else might have the question. Again, you can complete requirements 1 through 5 now, and then we will, requirements 1 through 3 we'll definitely discuss those next week in the morning. If you have any questions, bring them in, and I'll see you guys next week.
Yeah.
All right, and then we have quiz and homework. That'll be due by Friday night for chapter 2.